Welcome to our last Bank Counsel Roundtable of the year. Our topic today is Trends at Regulators, SEC, FINCEN, and CFIUS. I'm Erin Bryan, a partner in Dorsey's Finance and Restructuring Group. I'm co-chair of Dorsey's Consumer Financial Services Group. We are thrilled to see a wide range of practice areas represented among today's registered attendees because we believe this is a topic of relevance to every bank lawyer. I will begin today by introducing our panelists, and then we'll go over a few housekeeping notes before we begin. Our first speaker today will be Justin Huff. After 13 years of government service, Justin entered private practice, where he assists his clients as they navigate reviews by the Committee on Foreign Investment in the United States and the Defense Counterintelligence and Security Agency. Justin's last 4 years of government service were spent at the Department of the Treasury, where he served as a deputy director in the office responsible for overseeing and chairing CFIUS. Justin also held senior positions within the U.S. Department of Agriculture and the Office of the Director of National Intelligence. Our next speaker will be Tom Gorman. Tom defends federal law enforcement investigations and enforcement actions by the DOJ, SEC, CFTC, and other government agencies. He represents firms in complex business litigation, conducts corporate internal investigations, and advises firms on avoiding investigations and litigation through effective compliance. Tom's also the founder of Dorsey's annual Federal Enforcement Forum, a program which reports on and analyzes current trends in government enforcement investigations and actions. Our third speaker today will be Joe Liniac. Joe is a familiar face to our regular attendees. Joe is a longtime advisor to the financial services industry with the depth of experience that allows him to connect the dots for clients in the complex and sometimes conflicting regulatory and statutory schemes confronting financial intermediaries. Joe practices in Dorsey's Washington, D.C. and Southern California offices. And I'd also like to recognize Erica Andrews, who assisted with the development of this program and its materials. Erica is an associate in Dorsey's Trial and Government Enforcement and Corporate Investigations practice groups, where she represents clients involved in complex business litigation and government investigations and enforcement actions by entities such as the DOJ, FDIC, and SEC. Erica practices in our DC office. A few housekeeping notes. Today's program will be 60 minutes. The materials and attendance form are available for download from Dorsey's reminder email. Please return your completed attendance form to attendance@dorsey.com. We don't have time for Q&A today, but attendees may contact the speakers directly, or you can reach out to your trusted Dorsey contact. Speaker information is included in the materials. With that, I will turn it over to Justin Huff to discuss CFIUS.
Thanks, Erin. Good morning and good afternoon, everyone. It's good to be with you today. Each of these topics that we're going to cover this afternoon could be an entire presentation on their own. And so I'm going to touch briefly on CFIUS, what it is and how it impacts transactions today. And then as Erin had mentioned, if you have extra questions, feel free to reach out to me at any time. I'm happy to talk with you one-on-one and go over some questions that you may have. I think the first question that everyone always asks of me is, what is CFIUS? About 8 years ago, I was working at the Department of Agriculture and my boss came in and he said, what do you know about CFIUS? And I said, I honestly don't have any idea. And he said, I didn't either. It's some committee over at the Treasury Department. I need you to run over there, figure out what it is. They've asked for our help on a transaction. And so I did. I went over and went into a meeting and had a great experience, and ultimately it turned into a job. And so the first question people always ask me is this: how does it work? And so the Committee on Foreign Investment in the United States, or CFIUS, is an interagency panel that's authorized to conduct national security reviews of what they call covered transactions. And these are transactions including certain joint ventures that could result in the foreign control of a U.S. business, as well as certain non-controlling investments. The committee's goal is to evaluate whether a transaction will threaten the national security of the United States. It's made up of 9 member agencies, including the Treasury Department, which chairs the panel, as well as Commerce, State, Defense, and Justice, Homeland Security and Energy, as well as 2 White House offices. And for every single transaction, the committee comes to a conclusion that they review as whether or not this particular transaction threatens U.S. national security or not. If it doesn't, then the transaction can go forward, and if it does, then they have the opportunity to prohibit the transaction from moving forward. A question always comes up is, what's a U.S. business? And prior to about 3 years ago, it was an entity that is irrespective of nationality of the persons that control it, engaged in interstate commerce and activities in the United States, but it was extended only to those activities that happen here in the U.S. The rules changed a few years ago, and that highlighted language that's there on the screen was deleted. And that's important because the committee now looks at its jurisdiction and says, okay, we have a U.S. business, but maybe those national security concerns are actually occurring outside of the United States. And if so, do we need to take action? When the rule changed, they said they weren't going to look at the kind of extraterritorial considerations there, but we've seen in recent weeks where the committee has actually taken action based on activities that are happening outside of the United States. And I think that's really important to know and understand. Could you go to the next slide, Erin? So what happens? So by law, CFIUS is mandated to assess the potential national security consequences of the interaction between an identified threat and the vulnerabilities related to a proposed cross-border deal. It does so by assessing 2 major questions. First, does the foreign person present a threat to U.S. national security? And second, would the acquisition of this particular U.S. business by that foreign person expose a potential vulnerability? Currently, the U.S. government views investments from Russia and China as the most concerning, with investments from countries such as Canada, the UK, and Australia as less concerning. That doesn't mean that CFIUS will identify concerns with all Chinese investments or that investments from so-called friendly nations will be approved. Rather, CFIUS looks at each proposed transaction separately when assessing whether it has any concerns. The items listed on this slide are an example of some of the things the committee considers when conducting its national security investments. And let's go to the next slide. One of the more interesting facts I learned when I first was introduced to CFIUS is that the president has had authority to review foreign investments since the 1970s. The rules have been updated and changed over time, most recently in August of 2018, when Congress passed the bill called FIRMA, which is the Foreign Investment Risk Review Modernization Act. FIRMA was passed for a number of reasons. First, Congress wanted to codify how the committee had evolved during the prior 10 years. Second, Congress wanted to provide CFIUS with additional authorities to review more types of transactions. Third, Congress was concerned with the volume of Chinese investments and wanted to ensure the committee had the resources and authorities necessary to review those transactions. Many politicians, both Republicans and Democrats, noted that the concern with the Chinese investments was one of the main triggers for updating the CFIUS statute at that time. Following the passage of FIRMA for the first time, control was no longer the only standard for jurisdiction. Now CFIUS can review transactions that are non-controlling investments in certain circumstances. Additionally, certain transactions became subject to mandatory notification requirements, and I'll talk a little bit about that in a few moments. This slide shows a number of those key changes. This concept of non-controlling and non-passive investments in U.S. businesses called TID U.S. businesses is very important. And I'll spend a little bit of time speaking about those. TID U.S. businesses are businesses that are part of U.S. critical infrastructure, possess or maintain sensitive data, or manufacture or produce or design critical technologies controlled for export under U.S. export control laws. And finally, I think it's really important to know that CFIUS can now review real estate transactions for the first time, as well as require filing fees. So let's go to the next slide. So what is control? Control means the ability to direct or determine important matters about the U.S. business. This doesn't mean that you have to have a majority, more than 50% ownership interest in the company. but rather CFIUS looks and evaluates whether or not you have the ability to direct or determine these important matters. This can be done by how voting thresholds are set up. It can be done by your ability to influence the board. And this is really important. There's not any definitive guidance on what constitutes a dominant minority, but certain minority shareholder protections in and of themselves are not necessarily deemed to be controlling. Go to the next slide. So what are passive investments? Does this mean that CFIUS has jurisdiction over all inbound transactions? Well, the answer to that is no. Purely passive investments that are economic in nature are not subject to CFIUS's jurisdiction. There are dozens of examples in the regulations about how CFIUS defines that control, as I mentioned before. But companies often find themselves subject to CFIUS's jurisdiction when they bargain for certain rights that go beyond simple minority protections. Some of the things that we consider when we talk to clients about minority investments that are purely economical are not having a board seat or the right to appoint an observer to the board, not getting access to any non-public technical information about the company, or any other special rights that come along with your investment. If you'll go to the next slide. I'd mentioned earlier this concept of TID-US businesses. This is a new concept that was introduced 3 years ago, and it's important to understand that if you're making an investment, either a controlling or a non-controlling but non-passive investment in companies that operate in these areas, CFIUS can assert jurisdiction and review your transaction. Additionally, CFIUS in certain circumstances has required mandatory notifications prior to closing. So let's talk about each of one of these buckets here individually. If you go to the next slide. So critical technologies are certain technologies that are controlled for export under US export control laws. For example, a US business that's producing a technology that's subject to the International Traffic in Arms Regulations, which is the US's regulatory regime to restrict and control the export of defense and military related technologies to safeguard its national security, would be considered a critical technology company. And a foreign investment or an acquisition would trigger a mandatory notification prior to closing in most cases. On the next slide, we talk a little bit about what's called critical infrastructure and how it's been defined in the CFIUS regulations. These are systems and assets, whether they're physical or virtual, that are so vital to the United States that the incapacity or destruction of these systems would have a debilitating effect on national security. An appendix to the CFIUS regulations identified specific types of infrastructure and specific functions that a company would need to perform in connection with the infrastructure to be relevant for non-controlling investment transactions. And the final group on the next slide are sensitive data companies. And this is the type of data, these are identifiable data, i.e. data that can be used to distinguish or trace an individual's identity, that's maintained by a US business that targets or tailors products or services to US government personnel or its contractors, or that maintains and collects such data on greater than 1 million individuals, and that it fits in one of the categories that are identified here. I've highlighted genetic tests because that's an important one, because the committee decided that they don't need to reach that 1 million person threshold. If the company has any genetic information that's identifiable, that would be considered having a sensitive personal data of US citizens. So if you move to the next slide, what you'll see here is that then CFIUS has said, well, in certain circumstances, we want to learn about these foreign investments prior to closing. And so CFIUS requires that certain transactions involving these TID US businesses be notified at least 30 days before closing. Failing to notify CFIUS can result in a fine up to the value of the transaction, and that fine can be assessed on both the buyer and the seller. These notifications can be done either using a traditional CFIUS filing, a process that can take anywhere from 4 to 6 months, or by using a short form declaration. The short form declaration can be an effective way of receiving expedited CFIUS approval for less sensitive transactions. However, CFIUS can request a full filing following its review of a declaration, which can lengthen the process. As the slide points out, mandatory notifications are required for all investors who invest in US businesses with critical technologies, when the critical technology requires a US export authorization to the country of that foreign buyer. So if the US business has those defense articles that I talked about earlier, and it's being acquired by a French company, and it would require a license to ship those technologies to France. That would trigger the mandatory notification. Additionally, foreign government investors in TIDUS businesses, where there's a 25% investment in the company and a foreign government entity owns at least 49% of that investor, would also trigger a mandatory notification. We see that often in the sovereign wealth fund world, as well as state-owned enterprises out of China that can trigger the mandatory notifications. And again, this applies primarily to the infrastructure and the data types of companies. And if you hit the next slide, just want to highlight one thing that's become really important for companies. CFIUS can review transactions that are submitted voluntarily, and that's historically how they viewed or how they reviewed most transactions. But they can also call companies up and request that a filing be made, or they can review the transaction unilaterally under their own authorities. They can look at transactions pre and post closing. So if it doesn't require a mandatory notification, CFIUS can look at that transaction anyway, even after the deal is closed. In fact, they've opened up a new office, the Office of Monitoring and Enforcement, and it's dedicated to monitoring these non-notified transactions that weren't presented to the committee voluntarily. They get sources of information from all sorts of different places. They look at press reporting, different databases that are out there from subscription services. They have a tip line that they've established, and people will often call up and say, hey, my competition is being acquired by this Chinese investor. I mean, you should take a look at that. And periodically, they'll receive letters as well. I think this is really important for people to know and understand, because unless you go through the process, if CFIUS identifies a transaction, even years later, they can take a look at that transaction, and the committee's become extremely active in this area, and companies are getting a lot of questions about investments that were made even 3, 4, or 5 years ago. So I think that's very, very important. And I think that's the last slide, Erin, and we're going to move on to our next presenter with Tom.
Before you go, Justin, I have one question about the committee. As I think you probably know, under the securities laws, if companies don't submit to an inspection of their audit process, they can get delisted. That's been on the books since Sarbanes-Oxley in 2002, and the SEC just wrote some new regs on it like 2 weeks ago. They've never actually done this, and I think most people think that this is actually focused on Chinese companies who won't let anybody in to audit them. Does the committee ever get involved with any of those issues? Because the SEC has from time to time had cases, they've had hearings, they've had all sorts of things, but nothing's ever happened.
Yeah, that's a great question. So I think in my experience, what we've seen is the committee and the US government right now will look at all the tools in the toolbox to address its national security concerns. And so they may want to take a look at a transaction that, let's say they're going public, and they could refer that matter over to the SEC and say, hey, I know this is on the books as something that they're planning to do. We want you to kind of pump the brakes on the transaction and not let it go to the shareholders and not let it go public yet until we can identify whether or not we have potential national security concerns. And I think we're seeing a lot more cross collaboration from the different committees and enforcement agencies when transactions are being announced that are potentially problematic for the United States government. And so it'll be interesting to see how that continues over the next few months and years, especially into next year, as people within the government are really looking at and scrutinizing some of these transactions very, very closely.
Yeah, they just wrote some new regulations on this that were passed based on a statute that passed December 31st last year. But nobody's ever brought this together, so it's very segmented, and the Chinese companies just sort of thumb their nose at it. So, but it's an important protection because you don't know how good the audits really are.
Right. Absolutely.
All right. Thanks.
Great. Well, thank you, Justin. I appreciate that. It was very informative. And I'll turn it over now to Tom Gorman to talk about the direction of SEC enforcement.
Okay. Thank you, Erin. I appreciate that. SEC enforcement, as probably most of you know, has long been one of the bright spots, so to speak, for government enforcement. For years, the SEC has been considered to have probably the most effective and certainly one of the most well-known enforcement programs in government. And that has really driven the way SEC enforcement gets done. And people spend a lot of time trying to puzzle out how do I construct compliance programs for this? How do I deal with these guys? Where are they going to go next week? And the answer is they know, but most people don't. What you have to start with is a base of looking at the statutes the way they do, because most people don't. Most people look at these statutes like lawyers do. They read them, and then they look up the words in the dictionary. And then after they do that, they figure out exactly what it says, and they scale transactions around them. And then the staff comes in and says, sorry, you failed. And I'll show you some examples of these as they come up, because they don't read it that way. I can tell you from having been a member of the staff at the SEC for years and brought these enforcement cases and brought a lot of accounting cases, it's not walking around the rules of GAAP. It's not walking around what the statute says. The securities laws, and if you take nothing from this program, remember this, they aren't statutes, it's a code of ethics. Congress wrote them in the 30s, and they've said they're a code of ethics, and the SEC believes this, and they believe that they are trying to bring ethics to the marketplace, not rigid statutory compliance. Not that they're not looking at the statutes, they do. But the base of any compliance program that you want to have to defend these things is ethics. And if you don't do that, people will be trying to walk up to the edge and see if they can just walk around the corners, and the staff will come in, and you'll be at the beginning of what's going to be a 2 or 3 year investigation followed by some sort of an enforcement action. And while they're nice folks, I like them, some of them are friends of mine, you're not going to like the investigation. So it's ethics. That's where you want to start. And to try to give you a feel for how this really works, I'm going to start with some basic statistics, but statistics don't really tell the stories. Try to show you the way they are diversifying the program now, and then we're going to walk through a bunch of examples. So if we cut to the next slide, that'd be good. There's basically sort of 3 sources for statistics for this stuff. The best one source, they think they're the best, you can decide for yourself, is the staff. They put out the statistics every year. For the last several years, they put them out in this really glossy brochure that chats it up about all their cases. This year, they just put some statistical sheets attached to a press release. But the staff claimed that for fiscal 2021, remember the government's on a fiscal year that ends September 30th, so they can get stats for the congressional hearings. They said they brought 434 enforcement cases. It's okay, it's not a record. The record's up in like 600s, but they claim it's a 7% increase over the prior years. Frankly, I would find that incredibly surprising, and I think a lot of other people do, because they couldn't really effectively run an investigation the way they typically do over the last couple of years. They can't get people in the room to take testimony. They just can't. And doing it on Zoom is not the same thing as sitting across the table from somebody. So, but if we go to the next slide, you see other places, and this is some more of the SEC statistics. So let's clip this on to the next slide. Another source is the Cornerstone Research NYU report. But this is only focused on a subset of what's going on. It's focused on corporate transactions, corporate subsidiaries transactions, usually accounting, auditing, and disclosure issues. They reported there was only 53 of those cases. Now, this is a main group of cases for the SEC, 53, down 15% compared to the year before, down 32% from 2 years ago. Those are big drops. That's more like what I would have expected to see going on. We cut to the next slide. We have one more source here, actually, the next one after this. This is, the third source is a blog called SEC Actions, which happens to be getting written by me. So you can take that for what you want, but it tracks all the cases, and it publishes every Monday. It publishes a collection of all the cases from the week before. So you can count up the transactions. Since it's done on a yearly basis, it doesn't exactly match with what the staff is doing, but it gives you some idea of what's going on. And as you walk through some of these statistics over the first, say, 3 quarters, what you're going to find is there's like a couple of hundred cases that have been brought. Nothing close to what the staff said. What the differences are is almost impossible to tell, but it gives you some idea of where they are. So this slide that we've got up here on the monitor here is the first of 3. This is the first quarter, and it's worth a couple seconds just to take a look at these cases, because this is the first quarter of 2021. This is before Gary Gensler, who's now the chair, took over. It's before his new enforcement director took over. Actually, he didn't get there till about August. But first quarter, this is what they've got. They brought 48 cases. It's not very many. It's nothing close to the 400 plus that the staff put out. But we don't know how they counted those. They don't know how I counted mine. So there are differences. But there's, and the areas here, the staff in their releases listed 13 different areas. Generally in SEC actions, I break them into the top 4 or 5, and because the other ones start to get relatively small, some of them only have 1 or 2 cases in them. So in the first quarter, you could see misrepresentations, offering frauds, investment advisors, one of their big targets and has been for several years, and unregistered brokers, another one of their favorites. Those were the main categories. And look at the percentages of the cases. 27% of the cases that were been brought to date in the first quarter were that. If we flip to the next slide, you get a better look at what's going on. This is the summary of what I just said. So let's go to the next slide. This is 2Q21. So here you start to see the numbers picking up. There's more cases getting brought, and the areas that they're being brought in are relatively the same. They're not exactly the same. Offering frauds is now number 1. Investment advisors 2. Filings was one particular group because they had a large group of. If we flip to the next slide, you'll see it. They had a large group of cases focused on one filing, new filing that wasn't getting made, so it sort of skewed the numbers, but basically that's the way that they did the mix. Again, the top categories, the percentages, look at the numbers that were on this prior slide and think about those for a second. They're big chunks of what's going on. But if we flip to the third slide, they're different. So here you got 3Q. Now, the statistics in this quarter are a little skewed because this is the end of the government fiscal year. Usually in the last quarter of the government fiscal year, the commission goes at breakneck speed to file every case they can find because they want to push the stats up for their congressional hearings to make sure they get better budgeting. And this year was no particular difference. They brought 123 cases in the last quarter of the government fiscal year, the third quarter for the calendar year. And what's more, and that's interesting, but it's not that interesting. What's really interesting is look at the categories. Investment advisors, again, insider trading, something that these go up and down. Microcap fraud is all these small microcap cases where they run pump and dump manipulations. And again, unregistered brokers, one of their favorites. But look at the percentages. The percentages, these are the leading categories compared to the other ones where you had 2Q, 1Q, you would see 30%, 40% at the top, and then it would scale down to maybe 15 and 20%. So what this is telling you is they're doing something else. They're not just focusing on a handful of areas. What they're doing is they're broadening out. This is after Gensler takes over. He's had a couple of enforcement chiefs. His new enforcement chief who's there now had not really gotten there yet, but I believe will be a very effective guy. He was an AUSA in the Eastern District of New York. Very experienced litigator. But this here, these small percentages tell you that although the case law, the case numbers that they filed upped dramatically, they're all over the place. That tells you that they're taking a very diverse look at what's going on. And that has real implications for your compliance program, because you can't just say, I'll put in some insider trading stuff and I'll make sure my auditors are doing a good job, so the financial statements are looking pretty good and I'm good. Not so much. So we get to the next slide, please. So that's the kind of stuff that's going on. And that's what you get out of looking at the statistics. But let's take a closer look at exactly what's happening with some of the cases, which I think is actually more interesting. So let's go to the next slide. So what I've done on the slides, and we'll see how many of these we can do. I've broken these out into 10 different areas, not quite like the 13 that the SEC did. But good enough. So this is a new area, complex products. Complex products is something that they haven't really done much with over the years, but all of a sudden they've started bringing these kinds of cases. And the facts to most of them, like UBS here, or there's two on the next slide, are incredibly difficult to sort through. These are very sophisticated investment models, oftentimes combining options with futures, with securities to come to a particular result based on particular trends. Some of these products are only good for monitoring or investing in for like 1 day, 2 days, and the directions with the product, as it is with VXX, as it is with the products on the next two slides, say don't hold this stuff more than a day or two. Now, bringing these, some might question whether or not these products are actually investable. I question, frankly, whether or not you can run enough disclosure so that anybody other than a highly sophisticated market professional can figure out what this stuff is. But some of these brokers are selling this stuff. If you get to the next slide, we've got two more of these cases, and they're all basically the same. They're selling these products to everyday investors. There's no way that anybody could read these things. You get pages and pages. If you think you've seen fine print, take a look at the fine print of these things and what you can do with them. What the SEC is doing with them is not challenging the investment vehicle, which I would question whether or not you could write enough disclosure to disclose anything. But what they're doing is they're coming in and they're saying, you didn't really implement your compliance programs. That means you didn't teach these people how this worked. So when, for example, with the VXX product that was good for 1 day, they found investors who, on the recommendation of their brokers, held it for over a year. They had huge losses. The product's not meant to do that. What they said was, you brokerage firm, you Dow Jones Indexes, which runs another specialized index based on SIBO volatility, you're not teaching these people how to do this. Now, whether or not you think you can, I don't know. But this is what's going to happen if you're dealing with these kinds of things. These cases also highlight one of the favorite themes that you'll see go through here. That is gatekeepers, market professionals, lawyers, accountants, the other people who really let the investing public in here. Remember, the SEC is administering ethics, and they're trying to protect the Main Street investor. Main Street investors, seriously, I question why they're buying this kind of stuff, but they are. And if they are, the SEC is saying, we're going to make you brokerage firm, you brokers, teach these people how this works. Can't guarantee you against losses. These things have losses. Sometimes they make profits, but we can guarantee that the people have at least a good idea of what they're buying and what they're doing. So this is one set of cases. Let's flip to the next slide. Okay, crypto. Everybody likes to talk about crypto. Gary Gensler talks about crypto almost every other day. He also likes to talk about specs almost every other day, which is another subject we can do some other time. And he also likes to talk about the environment and that sort of thing. That's all great that he's talking about that stuff, and people think that's where the enforcement division's going. Not so. They bring crypto cases, but the crypto cases they bring look like this. Most of them actually are just for selling unregistered securities because they don't bother to comply with the rules. They think they're cryptos and they're coins, so they don't. And that's the only kind of cases there that they bring. Environmental cases, there's almost none. Blank check cases, which is what SPACs are, there's one. So that's not where enforcement is going. That's where Gary Gensler's talking up his regulatory authority and how far Congress will let him go because he needs some new statutes. That's what that's about. It's not about enforcement. So listen to Gary by all means, but look at the cases. This is a crypto case. This is the first so-called DeFi case. And it's got a lot of what I like to call crypto lingo in it. It's got smart contracts, it's got computer programs, it's got all kinds of cool stuff. But the fact of the matter is, this is just a routine, common, everyday fraud. These guys bought loans made for people who bought used cars. There's nothing sophisticated about that. DeFi just means it's not attached to a blockchain. So what? Blockchain is just a big ledger to keep track of stuff. That's all it is. DeFi has nothing to do with what these people did here. They bought these loans, they sold them, they sold interest in these things to people, and then they just didn't use the money the way that they said that they would. That's just a common everyday fraud, and that's what it is. And that's what happens with a lot of these fancy things with the fancy language. We've got DM tokens in here, which is something these folks invented. DeFi is something that came up a few years ago, and it shows up every once in a while. But you got to scrape down the lingo. Remember, we're looking at the ethics. We're selling this stuff to people, and we're saying, if you give me $10, I'm going to invest it in these things, and then you'll make money. And the fact of the matter is, they didn't invest in anything except themselves. So it's just a common everyday fraud. You can't get mystified by playing with these kinds of terms. Smart contracts will not save you. DeFi is not going to save you, and the blockchain is not going to save you. So let's go to the next slide. This is actually one of my favorite cases on the ethics topic. Under Armour. Under Armour had a years-long trend of making earnings, and it went on and on and on. All of a sudden, it stopped. Now, the public didn't get told it stopped. The company knew it stopped. What the company did was, as it says on the slide here, see in the second bullet point, they pulled forward their future sales. And they kept doing that and doing that and doing that. And they kept making the numbers until there wasn't anything else to pull forward. They took everything out of the cookie jar and it collapsed. There's no gap violations here. Excuse me. There's no gap violations in this case at all, none. But yet, the SEC brought an action against them, 17A2 and 3, negligent fraud, something only the SEC can do, and reporting rules and violations like that, and they fined them $9 million. Why? Because they weren't playing with the rules. They weren't playing consistent with the rules. Let's hit the next slide here. Now, this is an actual standard financial fraud case where they did violate GAAP, but the next one is not. So can we go to the next slide, Erin? There we go. This is conflicts. I'm going to sort of truncate a couple of these because I want to hit a couple more. Conflicts is one of the main areas that the SEC brings cases in. There are conflicts of interest everywhere. This was real simple. Here, TIAA Kraft was selling and marketing certain insurance products, and they weren't disclosing to people that, in fact, they were getting an interest in there. Conflict. I sell it to you, you pay the money, you get your coverage, and I get basically money back. You didn't know that. That's a conflict. They do this all the time, and this is one of the biggest things that people don't recognize. Wait, the next slide, Erin. Let's actually skip this because this is there's one more coming. Investment advisors. Go to the next one. Insider trading. This is a very interesting case, and this is why. Insider trading is something the SEC does all the time. Everybody thinks they know what it is. Not so. In this case, the trader here was a corporate executive inside a deal where they were talking M&A with two different partners. The M&A deal died. But this guy, the insider, went out and traded in a stock that was related to one of the parties in the deal and was in the same space. So he knew when that deal died, that space was going to become volatile and he could make money off trading it. He didn't trade in either one. It's the first case they've ever brought like this. But it's the same basic theory. You have material non-public information, you go and trade on it, and you profit on it before anybody else can do it. Not from the deal you thought about, which is the standard case, but from the overflow in the market ripple that you're going to get. This is a very important thing because this shows you what they're doing. This is ethics. This is not reading the statute, because reading the statute and looking it up in the dictionary is not going to get you to this. This is what you get if you're really looking at this as a matter of ethics. And the other slides that we've got here that talk about investment advisors, and the last one, which is a new area called the safeguard rule, which safeguards personal information for people. And it's designed to do that. And this is one of the first cases that they brought. I would commend you to take a look at the slides. What they're doing with this stuff is they're trying to protect the ethical views here. Their view is that their view really at the bottom line is that the filings, particularly MD&A, are designed to put you in the seat of the CEO of the company, let you see what he or she is looking at, not following, not necessarily just going along the rules and looking at the edges and seeing how close you can get before you get smacked, not just trying to show you what the rules actually literally say. What's the company doing? They want to know, and they want you to know, because it's your money. It's your investment, and they want to put you in that driver's seat. So this insider trading case, that's one of those. Under Armour, that's the rationale that is in Under Armour. If you read the case, I guarantee you will say it that way, but that's what they're doing. If you look at the safeguard case at the end of the slide, that's what you're going to see, because at the end of the day, what the SEC is really doing is they're running ethics. They're administering ethics. They're trying to protect the Main Street investor. And so when you come in citing all kinds of cases, they'll listen to them and they'll read them, and then they'll distinguish them, and then they'll go do their case anyways, which is exactly what they did with Under Armour. So when you do your compliance program, it's ethics. Don't just take the words of the statute. Don't let your people walk up to the edge and stick their toe in like they're hanging 10 off their surfboard or something. You want to do it in ethics. That's why Under Armour paid $9 million. And unless you want to pay that, construct a program based on ethics. Erin, thank you. And by the way, if anybody has any questions about this stuff, please feel free to shoot me an email.
Would you like me to just skip to the end of your slides?
You can run through. Yeah, sure. We can. Do we have enough time to do that?
Sure.
All right.
We have plenty of time if you wanted to.
That's the conclusion. These are just more examples of the same. Reg FD is basically just insider trading for corporations as opposed to individuals. And in this case, they did the same. They did exactly the opposite of Under Armour. Under Armour pulled in sales to boost up their trends so that they were good. These guys called up a bunch of analysts and talked down what was going to come out because they knew what was coming out in the next quarterly release was bad news. And when they talked it down so well, there was no impact in the market. Again, not fair, not ethical, not the way they do it. You got one or two more, I think, if you want to do these. But I think Mr. Liniac would probably like to say something. So let me turn it over to him.
All right, and with that, I will turn it over to Joe Liniac to talk about what is next for AML.
Oh, well, thank you very much, Erin. Thank you, Tom. My topic is AML regulation, which is certainly a concern to banks and other folks that are covered by FINCEN requirements. The quick answer is it's going to be a very, very busy 2022 in terms of what we're going to have to deal with. What I'd like to do is go through the changes in the law, the AML Act of 2020, and then give you a preview, which actually several things very important proposed regulations which came out last week that gives us a view of what we're going to have to be dealing with over the next year. Well, the AML Act of 2020 actually started around 2016 and 2017 when the New York Clearinghouse brought together stakeholders in the AML world. And those were law enforcement officials, FinCEN people, former FinCEN people, banks dealing with AML, small banks, particularly large banks, trying to figure out what do we need to do. The Bank Secrecy Act, broadly defined, over 30 years of age, where originally it was going after the Tony Sopranos of this world, and suddenly we're talking about global terrorism, and it no longer fit. It was really now a square peg in a round hole, and the whole concept was, what do we need to do in order to be able to fix it? One of the things that happened as part of this negotiation, which ended up being an adoption of the Anti-Money Laundering Act of 2020 by Congress, was a recognition that you can push FinCEN and Treasury to make changes, but you should not be mandating them because you don't have the expertise to do it, other than raising concerns and trying to arrive at a consensus, but turning over to FinCEN the discretion as to what they really should or should not be doing. Next slide, please. One of the things that was really important was, as I said, a change from typical run-of-the-mill low-level crimes to preventing global terrorism. And they changed within the AML Act the prism by which FinCEN and Treasury should be viewing AML policy in the future. And here's the ones that are actually pretty important. First of all, data sharing. Data sharing among every component of government and within the financial services industry. Concerns about what's taking place in the crazy world of cryptocurrency and new products that actually impact money laundering. I mean, to this day, the many law enforcement officials remain terribly concerned about the percentage of cryptocurrency trades which directly constitute money laundering. Innovation. Over the last 30 years, things have kind of changed. And what do we need to do in order to bring all of the technology and reporting up to speed based upon what's now available? And then two important components that were asked by the financial services industry, the banking industry. First of all, recognizing that AML compliance should be a risk-based compliance program. One size should not fit all. You can analyze your risk and you can structure your policies and procedures to accommodate that risk. And then finally, a concern being expressed actually starting about 2 years earlier when legal entities had to be identified and reported for control purposes, a complaint on the part of the banks that we just don't do this very well. And this is the type of thing that, frankly, the government should be doing and we should have access to it. But identifying legal entities and the ownership characteristics is something that they should be doing. Next slide, please. Well, as I mentioned, a lot of the pronouncements in the AML Act were suggestions or requests on the part of that FinCEN and Treasury take actions. And when you read them over, it there's not a lot of you shall as opposed to you should or you may. And I mentioned risk management, the effectiveness of improved technology, the usefulness of the data. And for many, many years, people were saying, wait a minute, we're filing all of these SARs and nobody looks at them. Nobody cares. We don't have the resources to deal with petty violations. So what do we need to do? Well, a request, take a look at SAR filing and currency transaction reports and see whether or not you can modify them. And certainly go back every 5 years and see whether or not you can do that. Great idea. Do a whole bunch of reports on terrorist threat patterns, on so-called de-risking. We don't like it, therefore we're going to fire you as a client and take away your accounts at a bank. Concerns about works of art being used for money laundering. Actually, that's a pretty hot topic nowadays. Telling FinCEN to cooperate both internally and cooperate internationally. Also on the part of the industry, a request that FinCEN talk to the industry. And during the last 5 years, there certainly was a pulling back on the part of FinCEN where they really did not want to be handing out advice and providing, if you will, safe harbors for conduct, and a request that FinCEN start to issue no action letters and interpretive guidance that can help the industry. And surprisingly, several months ago, FinCEN came out with a quote unquote report saying, yeah, it's a great idea. Maybe we should start telling people what the law is. Which, so again, it was this tension between discretion and what should be done in order to be able to improve the system. And FinCEN is responding favorably to it. Next slide, please. Okay, there were also a number of strengthening provisions to strengthen the structure of FinCEN, and we're going to see that percolating throughout the federal government. Several things which are important: putting Bank Secrecy Act officers at each functional regulator, creating these so-called attaché programs, including foreign counterparts, and putting them in other regulatory agencies, mandating AML training for federal examination personnel. Pretty good idea. Establishing subcommittees at FinCEN, subcommittees at working groups, some of which work, some of which have never worked, but it's a nice idea. We'll see whether or not that ends up having an impact. Directing that FinCEN hire technically proficient employees to work on AML projects. Again, the technology side. What a revolutionary idea this would be, that they should hire people who are actually competent. And then also acting as a resource for the on AML issues. Next slide, please. Okay, major changes directly affecting banks and other financial institutions. One of the things that they did is they changed the foreign bank subpoena power, where in the past you could subpoena records of a bank that has a correspondent relationship in the United States with a US correspondent bank. Well, they changed it. So now if you have a correspondent relationship in the United States, they can ask you for any record at that bank. Pretty significant change. There's something known as the Mutual Legal Assistance Treaties, and the Department of Justice currently has a provision saying that you should not be using this special authority unless you've gone through the treaty request to do it. Whether or not this is going to preempt that, or whether or not people will be required to go through the treaty issues. This is a pretty big deal, because that means that they can send the subpoena to any foreign bank located outside the United States that has a relationship with a foreign correspondent bank in the United States and ask for documents. Sharing SARS and other AML related data with foreign branches. It's a pilot program. We'll see whether or not that works. And this is very similar to the authority that you've got in FinCEN and FTC. If there's a bad guy, you can cut off that bad guy's account, and then you can call the bank down the street and say, hey, this is a bad guy here, don't take the account. And then something, again, pretty written, I think, by Captain Obvious, coordinate your approach with state and federal entities. Next slide, please. Keep open requests, that's been changed. New fines and penalties. Whenever Congress sees something that seems bad, they put in new civil money penalties. They've got so many civil money penalties authorities right now, it beats the band. If you're a bank, you don't need special AML requirements, but they did put in some clawback provisions and some notification for concealment of AML by foreign personalities. Something which is important, and if we have time, I'm going to ask Tom to talk about it. They copied the SEC whistleblower provisions and applied them to AMLs. For banks, this is going to be a big deal, because if you fire an employee, you may see them filing a counterclaim saying, I got fired because I am blowing the whistle on their AML non-compliance. There's bad guys there. And you will be off to the races. Next slide, please. Okay, now this is where we're really going to be spending a lot of time in the next year, and that's the Corporate Transparency Act. It's going to create a federal database for registering legal entities. The estimate is somewhere between 2 and 3 million legal entities are created every year, and you're going to have to identify, it's going to be a database created by the federal government, not by banks. It focuses on smaller corporations, not large publicly held corporations or corporations with existing histories. But the database will be able to be accessed by law enforcement officials, the Department of Justice, the IRS, that should terrify a few people, and the banks. So again, this is a major sea change that is going to be put in place. Next slide, please. Originally, they said, what should we do about this in April? And last week, they came out with a proposal, one of 3 proposals that are going to be issued. This one is, how do we implement it? The next one, which will be issued, will be what information must be reported. And then importantly, and again, this is a signal to the industry, amending the lenders' due diligence requirements for legal entities. And that is a signal that what currently are the rules will probably change radically in the next year. We are all going to have to pay attention to this. Next page, next slide, please. Now, who's going to apply? Well, there's 2 categories of reporting companies that have been proposed: a domestic reporting company, a company organized in the United States, and a foreign company who is registered with some Secretary of State to do business in the United States. And then there's a timing requirement. If you're an existing legal entity, prior to the effective date of this proposed regulation, you're going to have 1 year to register. If you're going to be a new entity after the effective date, you're going to have 14 days to register. And by the way, this is causing ripples in the industry. For example, in Delaware, lawyers are saying, wait a minute, we form small corporations all the time. Does that mean we've got this obligation? What if we don't do it properly? What is our liability? And again, this is going to be a very, very significant issue. How do you go about doing it? What information do you have to gather? What is your liability? And what is the degree of due diligence you're going to have to be following? Next slide, please. As I mentioned, it's mostly small corporations are going to be subject to this. Small corporations include general corporations, LLCs, LLPs, statutory trusts, other types of legal entities. And in addition, hidden in there, the entity that registers, the entity that must be reporting, likewise has to be identified. So that means that if you're a lawyer and you form a small company, you're going to have to identify yourself as the entity, as the person or law firm that formed the entity and give information to the government. Now, as I mentioned, there's about 24 exemptions for larger established legal entities, and we will see whether, how that works through the system and what type of guidance the FinCEN gives us. But the important point here, as I mentioned a moment ago, is that they're going to be changing the rules radically regarding customer due diligence, which you're going to have to be taking a look at carefully. Next slide. Effective dates, as is pretty typical for these types of regulatory issues. Congress said, get this done within the next year. Well, that's really fine, but there's no penalty for doing so. And practically speaking, we need regulations in order to put them into effect. We're going to have about, I estimate it's going to take about a year to put many of these rules in place, probably then a period before which they will be effective. So we're probably talking about, in terms of established legal entities that are reporting entities, 2 years from now. However, we're going to have to get comfortable with it. We're probably going to have to change our contracts with clients, our engagement letters with clients. People are going to have to understand what the reporting requirements are and what it means to be a reporting entity. And by the way, they have fine-tuned what is a beneficial ownership, in that in the past, it was really somewhat amorphous. They have really ended up throwing the kitchen sink at a description of what constitutes ownership. Again, a complete and total sea change in that regard. We're going to have to really pay attention. Next slide, please. And finally, if that was not enough, the day after they issued the new legal entity proposal, they also indicated the fact that, after about 30 years, we're now going to impose AML requirements on non-financial real estate transactions, which is going to upset that industry tremendously. Who's got to report? Why do you have to do it? Does that mean the appraiser has to report? Does that mean a registrar is going to have to report? Again, open-ended. They've asked about 60 different questions as to how they're going to go about implementing this, but they are going to implement it, and it will again be a significant sea change in terms of the real estate industry and what they've got to be concerned with. Again, if you're in this space, please pay attention. It's going to affect you. That's a quick rundown of this. I'll turn it back over to Erin.
Great, thank you, Joe. That was terrific. And thank you to all of our panelists, Justin Huff, Tom Gorman, and Joe Liniac, and Erica Andrews for her assistance with the materials. And a big thank you to all of our attendees for your support for coming today and throughout the year. We're looking forward to kicking off our 2022 series in January. If you have suggestions for topics that you'd like to hear about next year, feel free to reach out to me and let me know. But right now we have some wonderful topics in the works, and we look forward to seeing you in the new year. Thank you.